And right outside our Amherst studios, we got fair skies, 79 degrees. I'm Frank Arcuri, News Radio 930, WBEN, and WBEN.com. Follow us on Twitter at News Radio 930.
The following is paid programming.
It's time to talk taxes.
New friends, new opportunities, new partners. E.G. Tax.
It's Ask the Tax Lady with Esther Gulius and E.G. Tax on News Radio 930 WBEN. To reach Esther now, call 803-0930. Toll free at 1-800-616-9236. And cell calls are free at star 930. And now, live from the WBEN studios, it's Esther Gulius.
Hey, everybody, this is the Tax Lady, and this is our hour to talk taxes, and we will keep you so up to date and current. When you go to all those end of the summer parties, you can give people information that nobody knows but you, because you listen to Ask the Tax Lady. And I have in studio Chris Fabian. Hey, Chris.
Hello, Esther.
How are you, Christopher?
Fine.
That's cool. And Tiffany Fabian.
Hey there, Esther.
And I heard you're going to take the trek back out to Long Island again tomorrow.
Yeah, I'm going to feel like a Long Islander here pretty soon. Yeah.
That's what happens when your baby goes away to school, right?
Yeah. I every day it gets, I don't want to say it, easier. I don't know how to say it.
Well, I mean, I think that there's an adjustment. Everybody has an adjustment, right? Mm-hmm. Okay, we want to talk about some of the things that are happening in the wonderful world of taxes, and there's a lot of stuff going down the pike, but more than anything, you know, this is August, so we got the rest of August, September, October, November, and December, and the most sweeping tax reform that's happened in 30 years happened last December. And so if you're a small business person, if you're actually anybody, it's affected everybody. And so we want to talk about today kind of our subject matter, because we try to have a subject, but it doesn't have to be what we're talking about. You guys can call about anything tax and money related, and we want to help you. But today's subject is like, how do they compute your tax bill? I'll bet you don't know how your taxes are computed. What's taxable, what isn't taxable, just how do they get to the bottom line? I bet you a lot of you that are paying zero income taxes think you're paying taxes, but you're not. I mean, the truth is they just take it out of your paycheck, right, guys?
Mm-hmm. That's right.
People think that that's their taxes, but they get it all back at the end of the year. So many people have no idea. I would think most people don't have any idea how their taxes are computed. We're going to talk about that again, but if you have any questions, whether you've gotten bills, if you owe the IRS money, we do offers and compromise. Hey, Tiff?
Yep, we do. You know, you hear those commercials all the time that say you could pay, you owe a big outstanding liability to the IRS or New York State. Well, call this number and you could pay pennies on the dollar. Well, we do that. That's called an offer and compromise. And so we sit down, run all the numbers and present an offer to the IRS. And often it's pennies compared to what you owe. And it really gives you a clean slate.
And the thing is, instead of you charge, many of these firms charge like $3,000 to get started. We only charge like a couple $100 to get going, and we never really charge much at all. The thing is, we want to get people squared away with the federal and the state so that they can keep living their lives. There are some people that are listening that have had garnishments month after month after month, and they do nothing about it. Did we have something this week where somebody was being garnished, but when you took a look at it, you found out they didn't owe the money at all?
Chris?
Well, I know there's one of my clients came in with letters in regards to 14 and 15 saying they owe about $15,000 for not reporting all their income, but it turned out to be an ADP screw up. And they were getting that corrected, so that's going to be a ton of money that's now forgiven. Well, not forgiven, but reassessed.
Right?
Yep.
But they don't know it.
They don't know it.
I'm Esther Gulius, the tax lady from EG Tax, 8030930, 8030930, star 930 on your cell phone if you want to text us. What's our texting number? You guys know our texting number?
It is, oh my God.
99.
Here comes Frank.
30930.
30930.
Thank you, Frank. Isn't he such a good guy?
Yes.
All right, so let me just, a couple things I want to talk about, though, before we get into how to compute your taxes. if you're a company that wanted to repatriate, you had money left over in some other country, and you want to bring it back to the United States, the special low rates for repatriation of your foreign income to bring it back to the United States is 15.5% on cash and 8% on illiquid assets, and you can kind of do an installment sale on it, more or less. You can pay that over an 8-year period. So wanted to let people know that. And the other thing is, it's very interesting, they were talking about, and this is for those of you that have stock and other capital assets, they're talking about making the gain on your sale of stock based upon not what you paid for it, but how much you paid for it, including the
appreciation.
Inflation.
Yep.
So if you paid X amount of dollars for stock and inflation was X amount of dollars, then you get to adjust the basis of the stock by inflation. And then when you sell it, that's the gain. So this is something that Trump is proposing. And this week, Andrew Cuomo came out and said that if that's the case, the state of New York would lose $100 billion in capital gains, and he will decouple the computation for sale of stock on New York State because it'll cost him so much money.
Yikes.
That's another thing, right? And then the other thing is IRS and the Treasury Department are proposing, for those of you that have businesses, 100% depreciation deduction. So that's like unbelievable. So those are 3 things coming down the pike. Okay.
And, you said in the beginning, one of the most sweeping tax law changes in 30 years, and it's pretty interesting that tax forms aren't even out yet for people to start to get a grip of what it's.
I will tell you, this morning I was downloading something from one of the big accounting firms who basically said that this tax law that was passed last year not only was the biggest tax change in 30 years, but it has completely complicated the tax structure, and that's true. Didn't you yesterday, Christopher, say you had a 35-page memorandum on how to compute
the 20%?
On Forbes wrote an article about the 20% pass-through deduction, and it was 30. Yep, and it was 30.
It's only 35 pages long.
Yeah,
the explanation.
That's all.
That's it.
And when you think about it, small businesses, rental property, real estate investment trusts, that's a lot of people that this impacts.
And Esther, you talked about Cuomo saying if this occurs, he has to put a cap on it. But I think New York State hasn't even said how they're going to handle the SALT on the federal tax for the state and local income tax.
But here's the thing. On New York State, it's going to hurt New York State taxpayers, right? So, but this adjustment for inflation on sale of capital gains would cost the state money. So that's where they really, stood up and said, oh, no, we don't like that, right? All right. We're going to go. On the other side of the break, we got Bob who's waiting. Your phone calls, 8030930, 8030930, star 930 on a cell phone. We'll talk to you on the other side. Hey, that's a Jackson 5, right, Frank?
It is.
Yay, finally I got one. It's old enough, see? I'm Esther Golias, the tax lady from EG Tax. If you have any questions on our subject today, we're talking about how to compute your tax liability or anything else, it's completely A-OK, 8030930, 8030930, star 930 on cell phone. Well, I want you to put on your thinking caps. And I know we got calls waiting, but let's say you got a W-2 of $100,000. You're a family of 5, okay? 3 kids under the age of 17, your spouse, you have a modest home, and let's say you're in college full-time. You're back in college full-time. Do you know that after you take and you put money into an IRA, okay? So after you take student loan interest that this person paid, IRA deduction, standard deduction, all the credits for the kids, and the education credit, they owe you, you pay zero taxes, they owe you $1,400. So
Wow.
that's the way our system works. And if you'd like to know how that works for you, you can give us a call. Okay, let's go back to the phones. And we got Bob waiting. Hey, Bob, how can we help you?
Yes, I got a questions about charitable donations, taking it out of my 450, my deferred comp program, okay? 457 program.
So you want to do the rollover from your pension plan to take advantage of the rollover to pay for charitable contributions on an RMD. Is that what you're saying?
Exactly. Now, my question is, if I do that...
Well, you can't do it. It's got to be from an IRA.
Oh, I understand.
Okay.
I can't do it from a 457?
You have to do it from an IRA.
An IRA.
Right.
I don't-
So just roll over your 457 into an IRA and then take your IRA and roll it over to the charity.
Oh, okay. All right. Well, if I did that, that's giving me a tax advantage for that year, right?
Well, what it'll do is, let's say your RMD was supposed to be $20,000, all right? So what'll happen is $20,000 won't be income on your tax return.
Okay.
And that's it. You won't get any charitable deduction, but it won't be income on your tax return.
And it
So
won't
that-
impact the taxability of your Social Security.
Right, right.
Okay. Now, this is the crazy question I came up with in my own head. Can I then use that $20,000 as a charitable deduction in
No.
my itemized donations?
No, you aren't going to pay taxes on it, so you aren't able to double dip. You're not going to get the ability. First of all, it fulfills your RMD, and secondly, it's not taxable. So you've already kind of skinned the cat, so to speak. But you can't also take it as a charitable deduction.
I understand. I was just contemplating. I guess that's not going to...
That would be a really great idea, but that's not the way it's set up.
All right. Thank you.
All right. Thanks a lot, Bob. I'm Esther Golias, the tax lady, 803-0930, 803-0930, star 930 on a cell phone. And I know we have somebody waiting, but I want to talk about some of the things that aren't taxed. Many people don't know that their Social Security is not taxed if they have income under $25,000 from, including half their Social Security from taxable sources, and they're single, or $32,000 from other, including half their Social Security from other sources, under $32,000. That if you have, if you receive public benefits, that would be welfare or any kind of a
Food
government
stamps.
assistance. Pardon me, Chris?
Food stamps, rental
Food stamps.
assistance.
That's tax-free.
HEAP.
Yep.
Right. Inheritances. If you inherit cash or cash equivalent from a decedent. As a matter of fact, if you have a stepped-up basis because you inherited property or stock, because it actually went through the will, that's completely tax-free. Mm-hmm. Right?
Right.
However, what happens if they inherit a pension plan or an IRA?
Then that is taxable. However, on New York State, if the person who passed away was over the age of 59 and a half, they get to exclude $20,000 based upon all the decedents who receive the pension or IRA.
Beneficiaries.
Maximum, right?
Right.
Okay, so inheritances. Sale of personal residence. I know next week we have Judy Jack Lewis that's going to be on. For those of you that have been thinking about selling your house, this is like a phenomenal time to sell. Do you know that if you lived in your house for the last 2 out of the last 5 years, the first $250,000 of gain if you're single, $500,000 if you're married filing joint return, is tax-free. You don't have to buy another house. You don't have to reinvest it. It's just plain old tax-free. I mean, what a deal.
Yes. Yeah, absolutely.
And the market is so hot right now. If you've thought about selling, this is a great time to do it. And next week, tune in because we have Judy Lewis, who is like a realtor extraordinaire. Give you some tips on how to sell, right?
Yeah, and then down the road, speaking of that, we have Bob. Is that his name? Bob or Dan? I'm sorry. Dan, who helps with finding ways that legally to cut your property taxes. So that's pretty exciting
Sounds like
too.
A good idea.
Yeah.
All right. Other things that are tax free. Sale of capital assets if you're under the 15% tax bracket that you sold. Does that make sense to you guys?
Well, it does to me because I know what you're talking about. But if your tax bracket, actually now it's in the 12% bracket because of the lower
yeah,
new.
but it's 15%. They haven't changed that part.
Right, well,
it's true, but it is 15. You're right.
Yeah.
You're right.
So if you're low income and you have a stock out there, we'll say you may have invested in Apple and you paid it $100 a share, and now it's going for $300 a share. And so now you have a $30,000 gain on your hand. You could, if your income qualifies, you'll pay no tax on that gain on the federal government.
Right. But on New York State?
They want their money.
Of course they do. Okay. How about workers' comp?
Tax-free.
Right. VA benefits.
VA benefits is tax-free.
Right. Lawsuit settlements for personal injury.
Tax-free.
If you receive lawsuit money for lost wages, that would be taxable. But,
right.
Yeah.
And then the other thing is still through 2018, child support is tax-free. In 2019, child support and alimony are going to be tax-free on 2019 divorces.
Right. And going back to workman's comp, just be careful, because if your workman comp leads to where it should have been Social Security disability, then that Social Security would become taxable, and where in years past you were able to take the workman's comp offset as a deduction on your itemized.
Now you can't, because they've gotten rid of
that section.
Itemized
Yep.
deductions. Why don't we go back to the phones, and we're going to talk to Liz from Grand Island. Hey, Liz.
Hello.
Liz.
Liz?
Hello? Liz?
Yes, I'm here.
Okay.
Okay, what can we help you with?
Okay, I just retired recently, and I got a buyout on unused vacation time. And when I got my statement, I got hammered with federal tax and state tax on it. Is that typical because it was a vacation?
Well, we have good news and bad news for you. So they're required on a lump sum payment like that to take out a flat amount. However, at tax time, give her the good news, you guys.
Then all of that excess backup withholdings, you should get a larger refund come tax time. So that's the good news.
So if you're in the 12% tax bracket and they withheld 28%, that extra 16% would be a refund to you come next year.
So they're required to do excess withholdings, Liz, but you should see at tax time more of a windfall.
So in other words, now it's bad news, but at tax time you should get a larger refund.
Right. Well, we're gonna pay.
But it is shocking when you you think, oh, right, I'm going to get this money, and then you get the check and there is no money. But yeah, at tax time you should be a happy camper.
Yeah. Okay. Thanks very much.
All right. Thanks, Liz.
Congratulations.
I'm Esther Gullius, the tax lady from EG Tax. Hey, we got a text that came in. If you want to read it.
Yeah, it says, hello, Esther and team. I am 60, still working, and would like to withdraw $500 from my Roth IRA. Are there any penalties involved?
What do you guys say?
As long as the money has been in there for 5 years, you are good because you're over the magic age of 59 and a half. The next hurdle is the money had to be in there over 5 years.
Right. And the other thing is, the only other penalty there would be in the investment itself. Like, for instance, if you had put it into an insurance policy with a 5-year, that you had to keep it in there for 5 years, and you're breaking that term, there might be a penalty that the investment would charge.
Almost like
the
a
IRS
CD.
Wouldn't.
Yeah,
like a CD.
And then I would say for that gentleman who's still working, don't forget to put money into your 401k. And because you're over the age of 50, you can put up to $24,000 a year. So, which is really exciting. So don't forget to put money into your 401k if you have it.
All right. So we talked about tax-free investments. When they changed the tax law, except for what we just went over here, is there any income that would have been taxable before that is no longer taxable?
alimony.
Well,
Received.
that's
Next
next year,
year.
starting
Yeah.
in 19. But in 18, it's still taxable, right?
It
So
is.
everything that was taxable last year, your wages, your interest, your dividends, sale of stock, sale of rental property, pensions, annuities, your taxable portion of your Social Security, unemployment, New York State refund from last year with some limitations if you itemized, a miscellaneous income that is non-categorized, that would all still be potentially taxable, right?
Yes.
Okay. Then what happens to that income? The next section of the tax return is an adjustment. And how do adjustments work?
They will lower the amount of your taxable income.
And what are some of those things that are adjustments?
Student loan interest up to $2,500 per year per tax return.
That's still in there. Right?
That's still in there. Teachers, they get up to $250 if they're a teacher, K
So
through.
the teacher deduction for getting classroom supplies still in there.
HSAs.
HSAs, right? Health savings accounts. IRAs, still in there,
Yep.
right? Alimony, this is the last year for alimony on
On new divorces.
On newly adjudicated divorces where you have to pay alimony. So those of you paying alimony don't have her or he or whoever you're paying it to take it to court to have it modified, because right now we're not sure if a modified settlement is going to make it after 2019 taxable, non-deductible to the payer or not. But right now, anything that hasn't been adjudicated before 2019 is still going to be deductible to the payer and taxable to the payee, and that's an adjustment.
Yep.
Right?
That's right. So some people might, if they're about to get a divorce, they might want to consider getting it done
Real
this year.
fast.
Yes.
Make sure your attorney puts the pedal to the metal.
Yep.
And if you have an attorney that is not up to, when you say, gee, I hear next year I can't deduct the alimony, and your attorney says, really? You should have your attorney talk to us. We can do a three-way with them and get them up to date, because they may be great at divorces, but not so great at taxes.
Yep.
Right?
That's the music.
Okay. I'm Esther Golias, the tax lady from EG Tax, 8030930, 8030930. We're going to take a short break for news. We'll be back on the other side. Okay, Frank, you got me going. Who is this?
Weezer.
I should have known it was Weezer, my favorite band. Hey, I'm Esther Golias, the tax lady from EG Tax, 8030930, 8030930, star 930 on a cell phone. And we have, who's been waiting a long time?
Gary from Lockport.
Hey, Gary, how can we help you?
Hi, good afternoon. I had a question pertaining to Social Security benefits. Are they prorated through the year when one finally decides to take the benefit? Meaning, if someone becomes eligible, say at 62, and their benefit is going to be, say, $1,500, but they don't take the benefit at 62, they take it at 62 and a half. Is there an adjustment for those 6 months of increased benefit?
That I don't know.
Well, I mean, your benefit is determined when you take when you call them and you say you want, because it would be, if it's before normal retirement, your benefit will be decreased. So before normal retirement, which would be 66, then your benefit is decreased. So what you want to do is you want to make sure that you put a pencil to the paper and find out exactly how much your benefit is going to be decreased if you take it prior to normal retirement age.
Well, I had the report that they sent, so I guess you can gather it from online now, whether you take it at 62, 60, what's the next step? 65. They give you different amounts. If you retire today at 62, you would get XYZ. If you retire at 65, you get XYZ. At full retirement, I think 70 or something like that, you would get XYZ.
Yeah, well, every year you wait, it's an 8% increase.
Right. So what you want to do is check with Social Security and find out exactly. They'll tell you exactly how much your benefits are.
Okay. I see. Okay. Thank you very
All
much.
right. Thanks for waiting. I'm Esther Gullius, the tax lady, 8030930, 8030930, star 930 on a cell phone. The whole thing with Social Security is if you don't take it and you should pass away, they do not give your estate the money you didn't get. So what you need to do is understand that, like Chris says, you get 8% a year for each year you wait, but you're losing 100% of the money that you didn't take. Should you die shortly after starting to receive the money? We haven't figured out, what is it, like 16, 17 years you have to live past normal retirement age to break out even?
And if you go on our website, we have a spreadsheet that you can plug in what it would be if you waited.
But there's no doubt about it that if you wait till you're 70 and you get the full benefit, and you live past that to 96, you're a winner. The question is, will you live to be 96? And probably most of us will not. So,
right.
And I know that it's a conundrum because many investment advisors suggest you wait. And I'm always somebody that says a bird in the hand is worth two in the bush. So,
yeah, and you always say, Esther, then you have the money to invest and control. You know,
that's right. And then if you don't have to take the money out till you're 70 and a half, you start collecting at 66, for instance. You don't have to take the money out of your pension plan, so you have it for later, right? Which won't be taxed. All right. So we're talking about how your taxes are computed. After you get to adjustments, that's the portion where you itemize deductions or take a standard deduction. The new standard deduction is $12,000 if you're single, $24,000 if you're filing a joint return. You can take your itemized deductions, which comprise of deductible medical that exceeds 7.5% of your adjusted gross income, your taxes with a cap of $10,000 on New York State, that's a herder, interest on your mortgage and your home equity, provided that your home equity was used for home improvements, charitable deductions, casualty losses on a federally declared disaster area, and miscellaneous itemized deductions. So if your itemized deductions are more than your standard deduction, and I think it would be fairly easy for single people to hit that threshold as opposed to married people. And this year, you don't get anything for having dependent children.
Gee, all these encouraging things to get married, you know?
Well, it is definitely true. This change in the tax law made it so that it is not in your best interest to be married filing a joint return.
And I know,
to be single.
Tiff, you got a call yesterday where someone said, I want to buy a nice motor home. Can I write off that interest?
Nope.
And not anymore.
Right.
Not anymore.
And then he said to me, well, I'm still going to go get the motor home.
Right. And I think a lot of people feel that way. And those of you that have that second home, and you can't take the property taxes and the mortgage interest anymore unless your property taxes and everything come under $10,000. You'd be able to take it up to $10,000, your taxes as an itemized deduction. If you convert that second home into rental property, then a miracle happens.
Right. Then you
What is the miracle?
You can deduct the mortgage interest and the property taxes on the Schedule E, which is really nice, whereas you're limited on the current Schedule A.
I mean, you're not allowed it as an itemized
on the second,
interest,
on the second
right?
one, yep.
Okay, let's go back to the phones. I'm Esther Gullius, the tax lady, 8030930, 8030930, star 930 on the cell phone. And let's go back to the phones. We got Annie. Hey, Annie.
Hello.
Hi.
Hi. I just had a question regarding certified public accountants. Is it a general rule that if you were to get audited and the CPA prepared your taxes, are you on your own and you're the only service that offers it, or is that a general rule that they should offer it?
They should all have it be where they're with you and assist you all.
I don't know if anybody does it at no charge like we do. I'm sure there are some CPAs that just accompany you at no charge, and there's some that charge. You know, every different accountant has a different fee schedule. Something that we do at EG Taxes, we will accompany you on the audit at no charge. It's just been something that we felt like was built into our fee.
But I can tell you, Annie, I've been doing this for 17 years, and I could tell you the horror stories that I hear about what other people do, don't return phone calls, say they lost documents, and it just sort of breaks my heart.
If anybody if they're getting audited, even if we didn't prepare the return, we will accompany them on an audit and go over everything to help them get prepared. So if that helps you.
Okay.
Okay.
Good question.
Thanks, Annie.
Yeah, I just had a client last week, and I accompanied him on an audit. And it's really important that you don't go by yourself, because I was able to approach angles that he would have never thought of, and he would have put his head down low and said, "Okay, I'll accept it." Yep. But the truth is, accepting it changes the course of the future for him. And so you really have to look at the whole picture.
They say, "Oh, and by the way, we'll look at 2016 and 15, and
Well,
right?
They wanted to take, they would have changed the course of his future. They wouldn't have done
anyway.
Good.
I'm Esther Golias, the tax lady. 8030930, 8030930, star 930 on a cell phone. All right. Now this is next year. This is 2018, in the year we're in. After the itemized deductions or standard deduction, that's where the pass-through comes through, correct?
Mm-hmm. Correct.
Explain the pass-through so everybody understands. This is a brand new deduction.
Well, do you got 10 hours? No.
You can do it
so,
easily.
Yeah.
Chris.
If you're self-employed,
Thumbnail.
if you're self-employed, have a shareholder of an S corporation, LLC, partnership, or you have rental property that shows a profit, then that profit, you are entitled to a 20% subtraction from income, not your self-employment tax.
Income.
What was that?
Of the net income.
Of the net income. So after you take all your expenses, so you may have $200,000 gross, you're left with a $50,000 profit. Then on page 2, you would be able to subtract $10,000 from your taxable income.
Right, and if you're in the 22% bracket, that saves you $2,200.
Right.
Right?
Yep. So, I mean, it's for a short little synopsis of that.
Right. Now, there are
rules
all
upon
kinds
rules.
of twists and turns. If you're in a partnership with multiple partners, if your income exceeds $315,000 taxable income, there may be a cap, because then the 20% is limited to your 20% or your payroll taxes, or 25% plus part of depreciation. So there's some twists and turns in there. And like Chris said, if you have about 10 hours, but
personal services.
Just for simple explanation, after your taxable income, if you have self-employment income or rental property, or you're a member of an S corporation, then you're entitled to and you have a profit, then you have a 20% pass-through deduction after itemized deductions and standard deduction. That's next year.
Yes.
Right?
Yeah, that's a mouthful.
All right. I'm Esther Golias, the tax lady. 8030930, 8030930, star 930 on your cell phone. Now, I will tell you, if you're self-employed and you're wondering how this pass-through works, you want to make sure that and depreciation's all changing. You want to make sure that you talk to somebody before the end of the year, so you have time to figure out how this affects your tax return. All right, so after we come up with our pass-through, after the standard deduction, itemized deduction, after our taxable income, after our pass-through, then you get credits.
Right.
So that further reduces your tax liability.
Right. So say after the 20% pass-through, your taxable income gave you a tax liability of, we'll say, $5,000.
All right, then you can further reduce it by education credits. Now, an education credit, those are pretty much have stayed the same. So it's lifetime learning or
AOTC.
AOTC, American Opportunity Tax Credit, which could be up to how much money?
$2,500 for the AOTC.
Right, and so that would dollar for dollar reduce your tax liability. Mm-hmm. Then after that, then we got the child tax credit, and these are for kids under the age of 17, and it's a big credit.
Yep, this year it's $2,000.
$2,000 per kid.
Up to $1,400 is refundable.
So that's money they're going to send you back.
Mm-hmm.
And the brand new family. Yes, Chris.
Sorry, the big thing with the child tax credit is they increased the phase out from $130,000.
And so many people that couldn't have gotten this before because their income was too high, now it's up to $400,000.
That's really exciting.
So a lot of people that didn't get the child tax credit will now.
Mm-hmm.
So if you're driving in your car, you should be dancing on the road someplace. Stop the car and dance, right, if you have kids under the age of 17. Many people say to me, what happens if your kid is over 17? Well, they got a credit for that. New credit that's called the family credit.
That's right. It's a $500 credit for having someone over 17. That
still dependent upon you.
Correct.
Right?
Yep. So that could be your child. That could be mom, dad, aunt, uncle, boyfriend, girlfriend, someone in your tax home.
Okay. So what we're going to do, take a short break, and we're going to come back and give you the rest of the credits. And remember, these reduce the taxes that you pay. So you're going to find that many of you have never paid taxes in a long time. And this year you certainly may not pay it at all, especially if you have children under the age of 17. I'm Esther Gulius from EG Tax. This is WBEN Radio 930, and we'll be back on the other side.
No rest for the wicked. Money don't grow on trees. I got bills to pay.
I think most kids think money grow on trees, though, Frank. I'm pretty sure most family members know that there must be a tree in their backyard producing money. I'm Esther Golias, the tax lady from EG Tax, 8030930, 8030930, star 930 on the cell phone. A couple other things I want to go before we get to the phones again. Some of the other credits, child care credit is still in effect. So if you're paying for daycare, that's still a credit. Prior year alternative minimum tax, if you had AMT last year and there isn't any this year, you should get a credit for that. Energy credits are still in effect on certain, like the Tesla, right?
Mm-hmm.
Yep.
You might not get the Tesla.
You might not ever get the car, but you would get a credit.
Right.
The earned income credit is still in effect. They're going to increase that again. So for people that have that are working, that have income, like let's say under $50,000, there's money that the federal government wants to give you. So the bottom line, after you take your tax liability, then you reduce it by the credits. What's left is your real liability, and for many people, there is no liability. There's refunds that they owe you, and that's why you need to file your return. A lot of people call and say, do I have to file a return? You may not have to file a return, but you want to file a return because they want to give you money.
Mm-hmm. I know when we teach the tax class, it's a very good, hard concept to get across. What were you going to say?
I was going to say, going back to the credits and the energy credit, a big thing around here this time of year is solar. Solar is still there as a credit on the federal and the state, but what people have to realize is that it's a non-refundable credit.
Which means they're not going to give you the money back. You can only shelter taxes that you owe by the credit.
Right. So if you have no tax liability, say you're a senior and you have Social Security and a small pension of $10,000, you don't have any taxes, so the solar credit's not going to help you.
Right.
So if you're interested...
And so here's the thing. A lot of times these solar guys that are out selling the solar thing are salespeople. Mm-hmm. And they'll tell somebody, based upon this, you should save $15,000. Well, that only works if you have a tax liability.
That's right.
Right?
Yep. And they're getting smart. They think they are. They're now telling people, you don't have a tax liability? We'll put it in your daughter's name or your boyfriend's name.
Can't do that.
Of course, he kind of doesn't own the house, right?
Right.
Okay. Let's go back to the phones, and we got Mike. Hey, Mike, how can we help you? Thanks for waiting.
Hi, thanks for taking the call. I'm in Lockport, New York, and we have a beautiful main street here. And I've been looking to open a business. There's one landlord that owns a lot of the properties, and they won't even return my call. So I voiced my frustrations to another business owner, and they said, well, they don't return calls because it's better for them to leave them empty so they get the tax credit.
Oh, that's not true. Absolutely not true.
But But we were
a
looking
lot
for
of people
property
think
and we
that.
returned our call.
But here's the thing. The only money you really get back on your tax return is the money in your tax bracket. Let's say that person's in the 22% tax bracket and they end up with a $10,000 loss. They've saved $2,200. But if they lost 10,000 real dollars, it costs them $2,200. It costs them 10,000 to save 2,200. That makes no sense at all. So people you're going to find most people that are wealthy because they realize that they'd rather pay the taxes than to lose the money. Lost money is 100% tax.
Mm-hmm.
The net profit is multiplied by your tax bracket. Go on, Chris.
Well, I was going to say, I know what you're saying, Mike, because it is very frustrating because sometimes we run into that too. And the problem is with the IRS is they look at individuals with rental properties more than they do businesses who own rental properties. Because if you're had a rental house yourself that was vacant for 3 years and you were deducting everything on the Schedule E, you would get audited and you would lose. But these big real estate companies, and I think we all know a couple of them in town, who leave things vacant for 5, 10, 15 years, they never go after them because they're a corporation and you never see them go after corporations' rental properties.
But that isn't why they're keeping them vacant, though, Chris, right?
Well, I'm sure it's to help keep their income down so they're not.
But would you give up 100% to save 22%?
Well, you got some weird people out there. Trust me, I know you're thinking.
It doesn't make any sense to do it. So, but it is very frustrating because many times these bigger corporations too have salespeople who, like anybody, an employee is an employee is an employee, and if the employee is not doing their job, it's very frustrating.
Well, I know us trying to find a new corporate office, we would call people and they wouldn't return our phone call, right, Chris?
That's true.
Esther, you know?
Very true. Very true. So just because they have bad employees doesn't mean that that's their goal. I'm sure they'd like the money, but truly it's not better to lose the money.
Mm-hmm. Mm-hmm.
Okay?
Thank you.
All right, thanks.
Good question.
I'm Esther Gullius, the tax lady. We have Dave waiting. Hey, Dave, how can we help you, sir?
Hello. Just clarification on Schedule A, please.
Yeah.
I think I understand it, but sometimes it sounds different when I hear.
Okay.
Is it that whatever you claim on 5A or B, the sum of 5, 6, 7, and 8, which is line 9, that cannot be more than $10,000 in the future?
That is correct.
Are you talking about the Schedule A, talking about
taxes? The state taxes, yes.
That cannot be more than 10,000, correct.
So my state and local, and I use the general sales tax, so 5B and 6, it'll max out at 10 grand.
Right.
Oh, boy.
Yeah, I've been saying the same thing, Dave, as have a lot of Americans.
Now here's the kicker. If your wife is a working person and you're a working person, if you were both single, it'd be $10,000 for her and $10,000 for you.
Wow.
Yeah, and this comes in handy, too. For the first time this year, I bought a car, so I have that sales tax.
Mm-hmm.
Goes to the drain, too, as a write-off.
Yep.
Yeah. Okay, thank you.
All right, thanks a lot. I'm Esther Gullius, the tax lady, 8030930, 8030930, star 930 on a cell phone. It is very frustrating. It'll be interesting to see what New York State does, if anything, to rectify this SALT limitation.
And they say that they're going to do something because it really is. In New York State, we pay high taxes, and so it really would behoove New Yorkers for them to do something fair and judicious.
We have one more text that
we do. Right? Can I set up an IRA for a 4-year-old?
Well, if a 4-year-old's working,
right, got to have work earned.
Because the only way you can do an IRA is if the person to whom the IRA is being set up is working.
That's right.
So they have to have
earned.
Wages or self-employment income.
Right. But
so
that
would
they could set up a 529.
Once this kid gets older and he's working, then that's a great strategy.
Yeah. Now they could set up a 529 account, which is for the person.
Which is another good thing, and you can do 529s now for private school as well as college. The thing is, it's not deductible on the federal. The only thing that's deductible or isn't going to be taxed is the appreciation. So some 529s.
But it is deductible in the state.
Yeah, but they're not all that they cracked up to be,
Right.
I mean, they're better than nothing.
Right.
True. So if you have kids in college, you want to do $10,000 and you're in the 7% bracket for New York State, you're going to save $700, and that's good.
Right, but even though the federal government's now letting you take it out for grade school and high school, the New York State is saying no. So if you take it out for that, the money you once deducted, you now have to pay tax on everything that you take out.
That is true. That is true. So you'll find that the law on the federal is sometimes decoupled from New York State, so you have to add back what you thought was going to be a deduction, right?
Yep.
All right. Then on New York State, there's additions in New York State. You got to make sure when you're doing your New York State return that you add back municipal bond interest from other states. Like if you had an Arizona municipal bond, it's tax-free on the federal, you have to add that back on the state. And again, like you said, withdrawals from 529 plans that aren't sanctioned by New York State. Mm-hmm. Correct?
Correct.
Okay, during the week, if people need us, how do they get us?
They can call 632-7886 or click egtax.com. Don't forget, October 13th, we have the What's the Buzz financial seminar. We're going to have Jeff Katz, a lawyer. We're going to have a real estate agent. We're going to have insurance salesmen. Mike Hayfleck is going to be there talking about Social Security. Boron is going to be there talking about college planning. Esther's going to be there talking about tax reform. So you can register online at egtax.com or call the office. We're really excited about
and
What's the Buzz.
Our tax school's coming up in October, too, and I will tell you, if there ever was a year that you might want to go to tax school, this would be the year, because it is so, the whole thing, that what has changed is so substantial, and the planning. I mean, now you really have to plan, because there are large depreciation that can be taken on your investments. So you have to say to yourself, okay, if I take the depreciation, I'm going to get the biggest bang for the buck. So you want to make sure that you do the tax planning. And our tax school, which starts in October, is an absolutely great thing to do. There's no charge for the class. The only charge there is for the book. And we have them South Townsend, West Seneca, in Amherst,
Niagara Falls, and Lockport.
And yeah, right?
Yes.
Yeah. All right, and during the week, if you get any of those love letters that the state and federal are sending out, you can call EG Tax. We don't charge you to take a look at them. What percentage would you say that we save people?
About 80%.
Yeah, so don't pay the bill. Give us a call. Have a wonderful week. It was such a great summer. And we still got some more time to go. Until next week, I'm Esther Golias with Christopher Fabian, Tiffany Fabian. Thanks for listening. Thanks for your calls. God bless. Bye-bye.